Hey, what's happening? I'm Ross. Americans are struggling to pay their debt. They're struggling to keep up with their credit card debt and their car loans, and I suspect other types of debt. I just want to go over a little bit of data and some articles that I've come across here lately, just illustrating that point. We'll go over. So the first piece of data I'd like to show you is out of the Fed. This is the Federal Reserve of St. Louis. You can see the St. Louis Fed, and they put out data on pretty much everything, but this particular chart is about consumer loans, credit cards, and other revolving plans. So that would be anything that's revolving, not like an installment payment like a mortgage where you pay monthly, but something that's like a line of credit or a credit card. This is for all consumers. The level of debt has exploded over the last decade or so, right? All the way back in, I don't know what happened here, but back in 2010 we were at just above 300 billion, and then it shoots up to 650 billion or so right here. But anyways, you can see the level going up and up and up until COVID. And at COVID, one of the silver linings out of all the money that was printed and handed out is a lot of people paid off their debt. So you can see right here, from about 2020, March 2020, it starts going down, and it went down, all the way until about April of last year. And then you can see the debt starts to go up, creep up again. So basically, what this chart is illustrating is this is we're at the highest levels of debt that we ever have been in the history of this country, right? Closing in on $1 trillion, just above 900 billion here. So that chart really goes to showing that we've taken on more debt than we ever have as a nation, as far as credit card debt is concerned. But that's really not where you can kind of see the indications of cracks in the economy. But I'd like to then jump into another article I have, and this one's from Yahoo Finance. Wall Street warns of troubles brewing in auto loans as prices dip. And I don't want to read the whole thing, but I'm just going to go. I'm just going to go through the highlights here. Wells Fargo and Company. Obviously, you've heard of Wells Fargo, one of the largest banks in the nation. Wells Fargo and Company said that higher loss rates for loans it originated late last year contributed to an increase in write-offs for the period. Write-offs meaning they wrote those off as bad loans. They weren't going to get paid back for those. And I find it interesting to note that they put loans it originated late last year. Meaning that was probably still kind of when people had a lot of the government money sloshing around. Maybe people took that money and bought cars that they couldn't afford. I don't know. I just find it, noteworthy that they point out that it was late last year. Ally Financial Incorporated, the country's second largest auto lender, saw charge-offs for retail auto loans quadruple in the third quarter. And Fifth Third Bancorp said it's pulling back in its originations, right? So Ally Financial saw their retail auto loans charge-offs for their auto loans quadruple in one quarter. That's amazing, right? And Fifth Third is backing off on its originations, meaning it's not writing as many loans for used cars. Used car prices slumped 7% in the third quarter, the worst decline since the depth of the global financial crisis, according to data compiled by vehicle auction company Manheim. To me, I'm not in the market for a car, but to me, I think the prices of cars were off the change anyway. So it's bad news for if you sell cars, but if you're looking to buy a car, that's good news. So Ally, again, this is the second largest auto loan lender in the country. Ally warned investors this week that net charge-off rates may climb to 1.6 next year, a jump from 1.05% in the third quarter. Still, the rates remain below pre-pandemic levels, and CEO Jeffrey Brown was adamant his company doesn't need to pull back on originations. We still feel really good about new loans that we're originating today, Brown said. We're constantly trim the margins where we see incremental pockets of risk. The analytics behind this are very robust. We have weekly credit conversions and buy box adjustments, so it's a very fluid environment. And that's what I expect the CEO of the second largest auto loan lending company to say. Everything's good, but in my opinion, this is just the beginning, right? We're just getting started to. Unemployment is still relatively low. We haven't started to feel the pain yet, but yet we're starting to see the cracks, right? We're starting to see just the beginning of it, in my opinion. I don't have a crystal ball, and I'm just some random on the internet, so you got to do your own research, but these are my thoughts. When Wells Fargo first started to see signs of higher loss rates on loans, it originated just last year. The firm moved fast to tighten underwriting standards. The changes, combined with the impact of continued supply chain constraints, caused auto loan origination volumes to plummet 40% in the third quarter from a year earlier. Wow, 40%, that's a lot. I think Wells Fargo's saying, though, we'd rather not originate loans if they're going to go bad. So they tighten lending standards really quickly. And again, I think it's of note that they're pointing out that those are loans that they originated just last year. So was this, kind of some of the government money that was still being pushed out into the economy? People took that money and bought cars with it. Fifth Third is seeing more consumers, especially those with subprime credit scores who the company doesn't typically lend to, try to win concessions from lenders so they can keep their vehicles. Chief Credit Officer Richard Stein said, "People, if they have a job, they want to keep their car. They don't want to go buy a new one," Stein said. Yeah, that makes sense. I mean, because if you got a car and you can barely afford it, you don't want to be on the market for car prices are off the change. And I know they said earlier that used car prices slump, but they're still not down enough. They're doing a lot of things to keep their car and stay current or work through their lenders or work through with their lenders. Yeah, I suspect if you have a car and the car works and you're struggling to pay it, you're going to do everything you can to hold on to the car because you're probably not going to find one in that condition for cheaper right now. So again, it's just a little bit more evidence that we're seeing the auto loans defaults increase. Fifth Third, Wells Fargo, Ally, some heavy hitters in the industry are telling us that their charge offs are up. They're expecting bad loans. I'd like to go into another article we have here where the major banks are setting aside more and more money to account for bad loans. It says fear of recessions prompts U.S. banks to increase bad debt provisions. 6 of the biggest banks in the U.S., J.P. Morgan, Chase, Bank of America, Citigroup, Goldman Sachs, Wells Fargo, and Morgan Stanley plan to set aside about $4.5 billion to protect against loan losses in the third quarter earnings, Bloomberg report said. Again, you've got the 6 largest banks, or 6 of the biggest banks, at least in the U.S., saying that we expect that there's going to be we expect that some of these loans are going to go bad, and we're setting aside money to account for that, right? Fears of a looming recession and a tightening economy are pushing the country's big banks to increase bad debt provisions, according to a report from Bloomberg. By setting aside the massive reserves, banks are signaling they are anticipating having to handle more losses in the future as consumers continue to feel the squeeze of rising interest rate and soaring inflations. Again, they're just basically saying in layman's terms that we expect that people are going to start having problems paying their bills, paying their loans and their debts off. I don't want to read the whole thing. I'll just read the highlights again. In the second quarter of this year, J.P. Morgan reported significant losses and built up $428 million in bad loan reserves, and that sentiment doesn't seem to have changed for the bank. Earlier this week, J.P. Morgan CEO Jamie Dimon warned on CNBC that some kind of recession will be coming in the next 6 to 9 months. I don't know where Jamie Dimon is at. We're already in a recession. He's late. Maybe he's just saying that because he's some big CEO, so he doesn't want to admit it. But we're there already, buddy. Wells Fargo. We just talked about Wells Fargo and the auto loans, right? Wells Fargo also saw big losses in the second quarter from 2022, with early delinquencies, loans 30 to 89 days past due, increasing by $11.4 billion, 25% compared to the same period in 2021. That's a huge increase. 25% they've gone up in their delinquencies. So, and I don't know how much of this the car loans that we just read about factor into this, but again, these banks are starting to see that they're going to have problems with people paying these loans back. And from my perspective, this is just more indication that we are just starting to see what is going to be an undeniable recession. I feel we are already in a recession, but this is going to be undeniable when people, for the rest of this year and into next year and through 2023, I think we're going to be dealing with this. People are, inflation's up. People are having a hard time paying for their necessities, right? So they're having to make hard choices. People are not going to be able to pay their car loans. People aren't going to be able to pay their credit card debts. So I think this is just the beginning. So I got one more article I want to get into, kind of proving this point or illustrating this. It's out of Financial Times. American Express sets aside more money to cover potential loan losses. So again, just like the banks, we've got American Express, who had a relatively good third quarter, but they're setting aside more money as they anticipate more loans going bad. American Express set aside more money for bad loans than Wall Street expected, sending another potential warning about the health of U.S. consumer at a time of high inflation and rising interest rates. The credit card company built its reserves for bad loans by $387 million in its third quarter, a reversal from the $393 million release a year ago. It stated in its third quarter results on Friday. That took Amex provisions for credit losses to 778 million as of September 30th, up from 410 million 3 months earlier, and ahead of analysts' forecast of 717 million, according to a FactSet survey. So basically, what this is saying is American Express has $778 million set aside for bad loans. They're anticipating having bad loans in the neighborhood of $778 million, right? I guess the analysts or the people that invest in Wall Street, that watch Wall Street, they thought that, you know, Amex would set aside 717 million. Looks like Amex, has a gloomier outlook than those analysts did. So, and their stock dropped because of it. Even though, again, they had pretty good third quarter earnings. So, I won't go through the whole thing. I'll leave the links in the description. From my perspective, this is just the beginning. We're going to see a lot more of this. And I think with the Fed raising interest rates and us being in a recession, and I think on that recession piece of it, the third quarter numbers come out next week, I think, on the 26th or the 27th, this week actually. So we'll see what the GDP is. I suspect it's going to be negative growth again, and that's going to be 3 straight quarters of negative growth. I could be wrong. I don't have a crystal ball, so we'll see. But I think this not being able to pay loans off, that's just starting, right? We're going to see more repossessions. We're going to see more defaults on credit cards, more defaults on personal loans, as people are spending more and more money on the basic necessities. I mean, if you're spending more money on food, you're not very well probably not going to pay off your credit card. So, unfortunately, I think this is just the beginning. But I could be wrong. What do you think? Get at me in the comments. Yeah, my name is Ross. If you had any value out of this video, please consider giving me a thumbs up or possibly a subscribe. It doesn't cost you anything, but it would help me out immensely. Appreciate it. Peace.